Well, it's not every day that you get good tax news here in Australia, but earlier this week, we've had some massive news from Jim Chalmers coming out regarding the super tax, unrealised gains taxes, and a $3 million threshold. So if you want to know what the exact changes are, what my thoughts are, and where there could be a few loopholes, then definitely keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, personal development, and all things financial freedom. If you live in Australia and you love Australia like I do, then you need to get used to paying taxes for absolutely everything. Now, what's happened to my surprise is that they've come back from this announcement of a $3 million tax threshold and how they're going to tax us on unrealized capital gains. And I made videos on this channel a couple of months ago about how stupid this idea is. Well, guess what? They've now reversed it. So let's go into what the details are, what they're actually suggesting the new tax brackets will look like, and what does this actually mean for you? Let's dive in. The changes will now apply a two-tiered tax structure and only to realized gains, such as dividend or interest payments, and not to increases in the on-paper value of assets still being held as originally proposed. What was originally proposed was that if you had a balance over $3 million, if you made any gains, you would still have to pay taxes on it. So unrealized capital gains. That's very different to when you sell a property or sell assets and then you have a tax bill that you have to pay because you made a capital gains. What they had suggested was actually what we're going to do is, let's say for instance, you have a couple of investment properties, you have some dividends, you have some stocks in there as well, and say the value hits $3.1 million. On paper, it's worth $3.1 million. So when it comes time for them to assess your taxes, they're going to say, well, you're actually at 100K over the $3 million threshold, which means we're going to charge you a tax on the $100,000. You're going to turn around and go, well, how am I supposed to pay it? Because I haven't actually sold. So this makes no sense. Equally, if you did happen to pay it and then say there's volatility in the market, which there always is, and now it actually falls by $200,000 to $2.9 million, well, they're not going to give you a refund, are they? So it sounded really silly. And if a lot of your wealth was tied up in assets that you actually didn't want to sell, it would just force you to sell, which means you would actually make those capital gains, and now you're out of the market anyway. So that was a really flawed system, and I know a lot of rich people were considering just moving out of Australia full stop because it sounded so silly. So now they've adjusted it, and earnings on super balances between 3 million and 10 million will now attract a 30% concessional tax rate, doubling the existing 15%. While earning above $10 million will be taxed at 40%. But in a major turnaround, both the $3 million and $10 million thresholds will now be indexed yearly in line with inflation. This was the other part that was very controversial. It was that, hey, you might be young and you're like, $3 million, who cares? But it wasn't indexed, which means over time, as the currency devalues and there's inflation in the system, your assets that are right now currently worth maybe $2 million could be worth $5 million by the time you retire. And then it meant, well, actually, we put in the rules years ago, which is a $3 million hard cap. Now, if they're going to index it, and say they're going to index it to the inflation number, which they can just make up themselves, but even if it's indexed at, say, 3% or 4%, it still means significantly more by the time you actually retire. Now, to figure this out, we're going to put in a $3 million initial investment, which is actually how much your super would be worth right now. It's the indexed amount. And then let's say we are going up by 4%, and we're going to do this yearly, and it goes up like this. And say, for instance, you're 40 at the moment, it means another 20 years. If you're 30, it's another 30 years. So let's just say it's 20 years from now that you're planning to retire. So that means that threshold of $3 million will now actually be $6.5 million by the time you retire. And if you were to go ahead and look at what $10 million would look like, so you put in $10 million, 4%, 20 years, and that would mean that the upper threshold would actually be worth almost $22 million. So it doesn't sound like it's too bad now, because in order for you to actually hit these numbers, you've got to have invested really well. If you're then actually having to pay taxes, I think it's quite fair. The issue of indexing had been a major criticism of the original proposal, as it threatened to affect more Australians over time due to bracket creep. Treasurer Jim Chalmers has confirmed he worked with the Prime Minister to overhaul his plan, which he said the government was prepared to rework to get it through Parliament. What really blows my mind, and again, I'm not a political guy, but they drag me in to these conversations, is who was sitting there thinking this was a really good idea. It honestly feels like some people don't know how money works, especially when it comes to investing, and especially if you're in political parties. I don't care if you're a Liberal, Labor, or anything in between. I just don't think they have the right personnel with the right expertise to come out with suggestions like this. There's changes at the lower end as well. As well as changes affecting higher super balances, there will also be an increase to the tax offset for low income earners up to $810, up from the current $500. The so-called low-income super tax offset is designed to ensure low-income earners don't pay more tax on their super contributions than they do their regular incomes. From 1st of July 2027, it will apply to those earning up to $45,000, which is up from the current limit of $37,000, meaning another 3.1 million Australians will be eligible to receive the offset. Dr. Chalmers said this would effectively deliver an extra $15,000 on average to lower income earners upon retirement. To be honest, how much is $15,000 going to be worth in the bigger scheme of things? In fact, I actually do know it's going to make little to no difference at all. I think this is more of a political play that we need to do something for the lower end, but in practice, when you've got inflation at the levels they're at and what they're doing with the monetary policy and inflating asset prices, it actually won't make a difference. The superannuation industry peak body, ASFA, has welcomed the changes, saying they will make the system fairer and more sustainable in the long term. It's vital the super system is equitable and sustainable, and the changes proposed by the Treasurer are important moves in achieving these goals. The country's largest accounting body, CPA Australia, also welcomed the government's common sense changes, particularly the decision to index tax thresholds. Bracket creep already has a silent eroding effect on personal finances. So, if you don't know what this means, it's the same way that it applies to land taxes in some of the states. So for instance, in New South Wales, when I started investing like 11, 12 years ago, the bracket was close to about $600,000 of tax-free threshold in terms of land value. So that meant if you had a property and it wasn't your principal place of residence, so you were living in it, and the land value was worth more than $600,000, you would pay land tax. But because it's indexed, now that same number is almost $1.1 million. So yes, it does help, especially in the grand scheme of things, and you might not be affected by these things today, but that's looking at right now. In 20 years' time, how much is a dollar actually worth? I truly believe there's a world in which where you go to Macca's, you're paying $50 to $60 for just a single Happy Meal. And that is absurd to think about, but the same people that were buying it for $1 or $2 a long time ago are like scratching their head saying, how is this $15 now? Now, the original super tax proposal was announced 2 years ago, sparking considerable pushback from the different businesses and professional groups and from critics across different political persuasions. It was one of the Labor government's few revenue-raising initiatives, and its watering down is expected to leave a hole in the budget. However, Dr. Chalmers said the new plan would raise only slightly less than the original proposal in the short term. Over the 4-year forward estimates period, the altered tax arrangements are expected to raise $4.2 billion less, although that figure is expected to blow out over the median term due to threshold indexing. The new changes, agreed to by the federal cabinet on Monday, are still to go through Parliament. If they're passed, the new tax package will take effect from the 1st of July 2026, 1 year later than originally scheduled. Now, the way that it's currently set up is that you pay about a 15% tax rate on your super balance. So when you go out there and you're purchasing investment properties or you're going out building a stock portfolio in your super, realistically, you're paying about 10 to 15% depending on what age you're at and if you're actively working. While this does still sound like an amazing proposal change, the reality is it's still doubling the amount of tax you're paying on your super balance should you go on to sell property or assets. And as I prefaced in the start of this video, it's that we live in a country that is so obsessed with increasing tax revenue, going out there, pumping up the property market. And this is how the government over and over, doesn't matter what party it comes into power, suggests that that is the future for Australia. I honestly think there are better ways to do it, and I want to know what your comments are down below. Let me know, how should Australia actually grow out of their problems? I think the proof is in its pudding. You don't go and sell land overseas, you don't go and sell out all of our commodities and make it super expensive when it comes to energy and things like that. I think there's a world in which the economy can actually be more productive, raise more revenue for the government, and be utilized in the right way. Honestly, if you have a look at the budget, not just the current one, but even the previous ones for the last 10 years, you're really left scratching your head going, how are people okay with this much money being spent in such stupid ways? Now again, I'm a positive guy and I think that taxes are just the norm, so you better adapt if you want to live in Australia. I've come to terms with it. I was born here and I've seen a bunch of changes over time and I think they'll continue happening. As of right now, I'm still planning to live in Australia for the rest of my life, but I do expect that the taxes are going to start increasing over the time. If you're interested in growing wealth in your super, definitely go check out this video. It's how some people are going out building wealth 10x the speed at which they would have originally as well. If you have enjoyed this video, then definitely smash that like button and I'll catch you guys in the next one. Thanks guys.